Welcome to the Luna calculation tutorial. This short presentation will cover what liquidity is, the Luna equation, and define its key variables. Lastly, we will walk through a step-by-step guide for how to complete the calculation during your RFQ. Let's get started. First off, what is liquidity? Liquidity, as defined by the Nonprofit Finance Fund, is a measure of how much cash and near cash an organization has available, usually measured as the amount of assets in cash or cash equivalents less current liabilities. In other words, it is a measure of how much cash or assets that can be converted to cash to cover the bills. If your revenue has stopped completely, how much cash or cash equivalent assets can your organization liquidate to pay your bills? Now, with an understanding of liquidity, we can look at what is Luna and what is the Luna monthly liquidity ratio. Luna is defined as the estimated amount of unrestricted net assets that is liquid and available to pay your bills. The Luna monthly liquidity ratio provides an equation to calculate the amount of liquidity available to pay your monthly bills. Ultimately, your calculation will give you two numbers. First is the total dollar amount of liquidity. Second, in connection with your board-approved budget, you will determine how much cash you need per month to pay the bills and how many months of liquidity you have to pay them. This is the Luna calculation. There are three key variables: unrestricted net assets, fixed assets, and liabilities related to fixed assets. We will define these three next. Unrestricted net assets are net assets that have no restrictions. This will be a line item on your balance sheet below total liability section. It may also be named net worth if you are not using a nonprofit accounting term. In addition, if you have board-designated reserve, a quasi-endowment, the rules for accessing the reserve will determine if they are unrestricted for liquidity purposes. For your initial calculation, you should treat any such reserves as restricted and not include them. Variable number 2, net fixed assets. These are typically property, buildings, equipment, etc. This figure will be found in your balance sheet under the assets section. Generally, such assets are shown as a net amount, which is what you were looking for. Sometimes they are listed as gross fixed assets with a line item for accumulated depreciation and then the net amount. Our third one, liabilities related to fixed assets, are liabilities or debts that are related to fixed assets, usually such as a mortgage for a building or a loan for equipment. Make sure to include any current portion of long-term debt that may be included in the current liabilities, if there is a long-term debt related to the fixed assets. If you have current liabilities, they will be listed in your balance sheet under the liabilities section. Now that we have defined the key variables of the Luna equation, we are ready to walk step by step through completing that calculation. There are two parts. The first is the traditional Luna calculation, giving us the liquidity amount. The second is utilizing the Luna and the monthly cash needs to determine how many months of Luna liquidity your organization has. We will start with part 1. For part 1 of the Luna calculation, you'll be using your statement of financial position, otherwise known as a balance sheet. For step 1, now that we know the equation variables, we must identify the correct number for each variable on our balance sheet. For our example, we have identified the fixed assets and the unrestricted net assets. These have been identified by blue arrows and red circles. The fixed assets is under the line item equipment net, and unrestricted net assets is under the section Net Assets Unrestricted. Such as in our case, you may not have any liabilities related to fixed assets. Smaller and or newly established nonprofits often do not have long-term liabilities. Step 3, we will complete the calculation for Luna. Now that we have established our variable numbers, we plug those into the equation. Unrestricted net assets, 5.8, fixed assets, 160,000, liabilities related to fixed assets, 0, as we have none. This results in the calculation of 5.6 million. Now that we have established the organization's Luna, in other words, the organization's liquid unrestricted net assets, we can move on to part 2, determining the months of Luna liquidity. Part 2 is divided into 3 steps. You'll be looking at monthly cash needs and liquidity. It is important to recognize that we are going to compare Luna at a point in time to the future cash needs of the organization. This is especially important if the organization is growing, shrinking, or has large changes in future cash needs. For step 1, you must identify your board-approved operating budget. Within this budget, you will identify your total budgeted expenses. We will provide an example next. For step 2, we will be determining your monthly cash needs for 1 month. How much does it cost to pay your monthly bills? Please note that generally your expenses are not evenly distributed during the year. If you have a significant concentration of expenses, for example, most of your expenses occur during a 3 to 4 month period, you should use the average expenses during that period as your monthly cash needs. Once that is established, for step 3, you will utilize Luna that we established in part 1 and divide that by your monthly cash needs. Next, we will go through an example. You probably have a board-approved budget that looks something like this, where you list all your projected revenue and budgeted expenses for the year. This is where you follow step 1, identify the operating expenses. Ours are identified by a red circle. We've completed step 1, identifying the board-approved expenses, 15 million. The second step is to determine the monthly cash needs for a single month. Following the equation, you will divide 15 million by 12. We determine that this organization needs 1.25 million per month to meet their expenses. For step 3, our last step, now that we know the monthly cash needs for 1 month and Luna, we can calculate the months of liquidity. 5.6 divided by 1.25. This calculation gives us 4.5 months. This means that if this organization were to lose all of its revenue, it would have 4.5 months of liquidity to pay its bills. This concludes our Luna calculation tutorial video. Thank you very much for being with us. If you have any additional questions, please don't hesitate to reach out to the Commission of Arts and Culture staff. Thank you.